Hello everybody. Welcome back to another video. We're going to be talking about dividend investing and one strategy that I'm using. This is not financial advice, just some educational material. Good news in the markets today. The S&P 500 is up. Everything seems to be up today. Headline: NASDAQ end within inches of records. So everything is up, which can be good, but it can leave you wondering if there's anything good to buy, like on discount or something like that. Well, with this strategy, we don't have to think so much about that. And once again, this is just one strategy among many strategies that I am doing. It's a dividend strategy, and we'll put this up on the screen here. Okay, might need to adjust this a little bit. But we're going to do a portfolio update. Okay, we'll move this in a second. Um, these are my current holdings, and we're trying to do a dividend snowball type of thing here for passive income. So we're going to go through all these holdings, and I've done a little bit more research on two of these, which I said I would do, and I'm going to be including them in this now based on some new information that I have gotten through some research, and we'll go through all of these. But I just want to say, you know, the younger you are, the earlier you can start doing this stuff, the more effective it is. I wanted to build a passive income type of strategy where I'm making money while I sleep and putting my money to work in a way that I can understand. Disclosure that this is not the only strategy that I have. It's kind of like a diversification. So I have some kind of more traditional funds. I have some funds that are probably considered more risky. And I've had those. And now I'm diversifying into this type of strategy. And I'm going to comment on a few different things here. We're going to go over the yields and everything. But the earlier you start this, the more the compounding effect will have time to take effect. And there's a lot of people that aren't investing at all. And if you start this when you're 19 or 20, you can even do it in accounts that lets you take out the money if you need a big purchase later. Maybe you need like a down payment on a house, but you could do this for 5 years before you're going to buy a house, and then take the money and use it for a down payment. Um, Please try to understand the tax situations. It's not really what I'm going into here, but um, this is about passive income. It's also about retirement. Again, it's not financial advice, it's just one strategy that I'm trying to share with you. And it's almost the end of the month of June, so um, let me move the screen a little bit. This is our little Excel situation going on, and it's nothing fancy, but I wanted to be able to have a way to show some of this. So we've got different months here. We started basically at the beginning of April, and in these columns here are going over are the dividends. This is the monthly total. Oops. This is the monthly total, and this is going to be the total for the year, and there'll be a grand total of all the dividends. So I'm growing this really quickly. I think one of the best things to do is to put on auto buys if you can, to kind of automate the purchases within your budget. And anyways, in June we got 308. I'll just kind of round these simply. We got a $3 dividend, and this information comes in Robinhood as well, where it has the dates you got. It'll show you upcoming pending dividends, which I think you passed this certain date, so that's coming, and then the dividends that you're getting, and um, so all I'm doing is I'm taking these numbers and I'm putting them over here. So we got $3, $6, $2, $6, 31 cents, $5, another 31, 7, 7, 7, 7. And yeah, these are all coming from here. Here's your 7, 7, 7, 7. These are all from, these ones are from Yield Max, which I wasn't including before, but I'll talk about that in a little bit. I know people have a lot of opinions on that, and that's okay. We all have our different risk tolerances and stuff. So I'm including, these are pending, but they're going to come in. I think there's two more that are going to, over on the right here. These are the ones that are pending. I think there's still two more that are supposed to come in before the end of the month, but I'm not sure as soon as I can make another video, so I'm just making this for what we have now. And with all of these for June, it's 55.93 for June, and that's bringing us to 80 so far for the year, and we've got about half the year left. So let's do a little bit of math. One of my favorite things to do is to look at the daily. So if we've got 55 a month divided by, we'll do 30 days. So that's about $1.80 per day, which is pretty nice. And then let's see, we've got 1, 2, 3, 4, 5, 6 months left. So if we keep this at 55 a month times 6 more months, we're going to bring in another $330 by the end of the year, plus the 80 we've already got. So that's almost 500, or that's almost $400. Yeah, that's 410, right? Plus 80, 410 for this year, which is pretty good. But I'm expecting to grow this, and then these dividends, almost all of them are reinvested. Some of them, I think there's one that I'm not reinvesting because I want to choose when I want to reinvest it, but it's a little bit more of an active thing. So yeah, right now 55 a month in passive income. Again, this is just one strategy, and it's a diversification from some other more like S&P 500 overall strategies. So what I want to do is take a look at these actual holdings. Now, I've seen some people that these are all of them that I have. And it's tempting to want to diversify more because, as I've said before, part of this is I like the psychological part of seeing these dividends come in, right? Like Robinhood will sometimes alert you, you just got this dividend, you just got this dividend. And I don't know if I'm getting one every week. There's strategies where people hold so many different funds that they'll get a dividend every day, even if it's only 10 cents, and they get to get that psychological effect of getting that passive income and seeing you can spread this out so widely that you're getting a dividend every day or every other day. Um, Not really sure that doesn't really seem like the way I want to do things. I'd rather be slightly more concentrated. I've been looking at some other funds and thinking about spreading out a little bit more, but I think you should have a variety, and there's a lot of reasons for that. One of them is that if you're only in one sector, like let's say you had real estate dividends, which I'm not doing. I have reasons for not wanting to do real estate, but if you only did real estate, then there was an issue with the real estate market. Your whole account could go down and be affected. So, for example, you may consider being in um, different types of funds. Um, you can be in spread out between like energy sectors, real estate sectors, large fund sectors, and that way, yeah, if something happened to the real estate, then it's more likely your energy sector ones would not be affected, and vice versa. So you do want, I think I want some diversification, but not massively. So let's go through this. What you're seeing here is this is the this number here, this percentage is the total return for what I'm holding, and since I've held and reinvested. So QQQI, the overall is so the overall fund that I'm holding has gone up 1.72%. This is not the dividend yield. JEPQ is up 3%. MSTY is up 3%. SPYI 1%. YMAX is down about half a percent. Claus is up about half a percent, and JEPI is up about half a percent. And this is calculated including the dividend reinvestments and the weekly buys. And we'll go over the yields for these, and I'm going to include some of these more risky things and talk about those. But you know, I want to encourage people that show them this is a way you can do things. Again, it's not financial advice, but in general, that this can be very important for the future, can be very important for my future and getting that passive income up to hundreds of dollars a month. Right now, we're at a few $100s a year, and as those payments roll back in, then we'll see that snowball effect. So we'll look these up. QQQI, hopefully this will work. Let's see, QQQI. Of course, it's not going to want to work for me this time. is not what I typed in. There we go. So this is a NASDAQ following fund. Oh, look, it's popping up because the whole market went up today. This following larger market type of thing. It's up almost a whole percent today. But what we're looking at is this number down here, this yield, and then we minus off the expense ratio. And I'm just going to do it quick and dirty. So we'll just say 14%. Make this a little smaller. JEPQ. This is another large NASDAQ situation type of fund. This is, we'll call this 11%. I'll come back to MSTY, SPYI. Again, these are not the only funds out there, but so this one, the expense ratio, we'll call this 11.5 because we're just gonna kind of average everything out. This is really closer to 12, but it's okay. And this is SPYI. The reason I'm skipping MSTY, I'm going to come back to YMAX as well, is because these are kind of special. Some people consider them very high risk, and you'll see why, but I think they're going to be okay. Maybe I'll make another video on exactly why they're higher risk. Clause. I'll show you a lot of times, like the strategy for a fund like this is to stay in a very concentrated range where think we had this tariff dip here in April, but we're expecting the fund to kind of stay in a very concentrated range. The yield on this one a little bit less. We'll call it 8%. And then the last one down here, JEPI. We'll call this 7.5%. One of the ones I am considering is SCHD, which is super popular for these types of strategies. The yield is a lot lower. Usually hovers around 4%, but it follows. I think it follows. Yeah, it follows a large index, which will follow the overall stock market a little bit closer. So we may see this start to go up since the market is reaching all-time highs. Could be a good time to get into this, but this one's also pretty popular. I have not included it, but I am thinking about it to diversify a little bit more, but I don't hold that. So let's do MSTY. This one's considered much more risky, and you'll see why. The yield is 140%, which is completely insane, super, super high. This is extremely unusual. I would not recommend, not that I'm recommending anything, but it's a smaller holding of mine, and I think it's generally at a low. I do not automatically reinvest the dividends on this. Um, so when I calculate my yield, I'm just going to do some kind of average, but um, I am getting dividend payouts from this. And then the other one is called YMAX, which is kind of similar, but I'll just put in, yeah, 140%. This is per year, so each payment will be whatever this is, percentage divided by 12, for the monthly payout. And then we have YMAX. Again, this is a smaller holding. Um, See, this is 63% yield. That's per year. And then the expense ratio is pretty high. Let's look at the. This fund hasn't been around as long. It's only been around like a year and a half. Um, the problem with these really high risk, the type of fund that they are, won't go into all that, but with this super high yield, 63%, basically what people say is that as these dividends get paid out, people take their money out, and then the fund overall goes down over time. That's kind of the fear with this kind of thing. Um, so people worry that this trend line of it trending down will just continue and continue. Um, so right now, and same thing goes for MSTY, 63%. So, like right now in YMAX, I'm down 0.46%. But if I take the 63% divided by 12 months, um, I'm making in dividends 5% back every month. So as long as the fund doesn't go down more than 5%, if the fund goes down 5% per month, then you're just breaking even. Then when you add taxes, you could be getting behind. So the fear with these ones is that it the the overall fund drops a lot. Same thing with MSTY. Um, if we look at that one, MSTY, I'm not going to be able to get the exact numbers here, but um, it's gone. I mean, the fund at its highest point was up to 42, and it was up at 35. So even though it's got 140% yield, if the price of the fund was up to $37 and now it's at $21, if it even in this time, if you put in everything at this price and then it drops down to $21, you've lost like 100, you've lost like 50% or something. So the yield you're bringing in has to beat that drop. Now, I think that this is going to trend back upwards. That's my guess. So I feel okay about this. But there's a risk because as these dividends get paid out, if people continue to take their money out, then the fund will just continue to collapse in price, um, which is a risk. So you may want, I want to consider having these as smaller holdings, um, but I am willing to take the risk. I saw some interviews with the people that run this fund and the other high risk one, so I feel okay about it. And that's that. The other funds, SPYI, for example, this is still a very chunky 12% yield, and these are not so high risk. These will tend to follow the overall market. Um, so, next thing I want to do is get my overall yield. So, when I did this before, I just skipped MSTY and YMAX. So I'm going to do like a super conservative thing when I calculate these, and I'll call them 20% because I'll go with like worst case scenario that the fund really starts to drop. But 20% yield is still like really high. But probably they're not going to drop, and the dividends I get will be higher than this. So, how do we do this? We'll take um, all of these yields. Now, I'm not weighting these, although the right thing to do would be to weight them, but that's okay. We're just going to do quick and dirty. So, we'll do 14% plus 11% plus 20%. I'm calling MSTY 20 plus 11.5 plus YMAX, we'll call it 20 plus 8 plus 7.5. We get a total, and then we're going to divide that by the number 1, 2, 3, 4, 5, 6, 7. So divided by 7, and we have a total with the conservative thing I did of 13% overall. Between all of these. So that's okay. That's a quick and dirty type of thing. I think that if these yields stay high and these funds stay good as I watch them, um, our overall is actually going to be higher, but uh, that's what I'm going to go with. And then, so the last thing, which is one of the more motivating things, in my opinion, is go to this compound interest calculator. This is from investor.gov. There are other compound interest calculators that have some more details, but this is good enough for me. So, initial investment. So, right now we've got about 6,500 in there, and I'll do a couple different monthly contributions, but if we do 500 a month into all of this, we'll do 30 years. Our interest rate is 13%. Do a variant of 1, and then we're compounding monthly. Calculate. So this is saying in 30 years you'll have 2.5 million, and I go down to show table down here, and it'll show me what year. What I'm most interested in is what year it's going to hit a million. So at this rate, it's going to take 24 years. Sorry, we got to look at the middle. It'll take 24 years to hit a million, and that's kind of the point at which, with this rate a person could potentially coast, stop putting money back in, and it should be paying about 100K per year at this 24 year. Um, what I'm hoping to do is do something more like 2,000 a month. And this will put me at 9 million in 30 years, but I want to get to 1 million sooner. So if I can do 2,000 a month into this, uh, we'll hit that million mark somewhere between year 14 and year 15. Um, but the sooner you start, the better. So even if you could do 500 a month in something like this, and let's say you were able to start with 5K, if you were 30 years old at year zero, then with just this type of strategy, at 60 years old, you'd hit 2.4 million. And you'd hit that million mark at 54 years old. You'd hit that 1 million. If you started when you were 30 with $500 a month and 500 or 5,000 starting. So I do encourage people to do some of these calculations, play around with the numbers. You started with 1,000 and you did 200 a month. Let's change this to 40 years. Say you started when you were 20 and you did this the whole time. The way that this curve goes shows the compounding effect, like the snowball effect. So if you were 20 and you started doing this with just $200 a month, you would hit the million actually earlier at about 51. And when you were 60, this is saying you'd have 3 million. Start with 5,000 and just do, let's say you were 40 and you did the same amount per month, started with a little bit more, you only did 20 years. Yeah, the difference is massive. So, starting with more starting, but your monthly is still 200. If you were 40 and you started doing this when you're 60, you'd only have 200,000. I saw this video that was saying how much do you need to contribute at different ages, and let's change this to 30. If you were 30 years old and you wanted a million by the time you were 60, if you were exactly 30, you want a million by the time you were 60, you could get away, if you started with 5K, you could get away with just doing 200 a month into something like this. But if you were 35, when you were 60, you'd only have half of that. So what we need to do is we need to figure out, if you were 35, how much would you have to contribute a month in something like this to get to a million by the time you're 60? So 200 a month is not going to cut it. Let's try 400 a month. You're 25. Okay, so if you're 35, now, you're only adding 5 more years, but you have to double your monthly contribution um, to get to that by 60. And you'd be at 55, you'd still only be halfway there. And um, I mean, you'd still be bringing in 50K a year in dividends, which isn't nothing. But the reason we want to get to that million is because we want to be bringing in about 100K a year um, to then coast out. Um, so that's the portfolio update. And this is where I'm at. We're only at, what did we say? 455 times 6 months, 330, and then times 2. So we're only at 660 a year right now. But if we can also do some things on a calculator, so we can say if, because right now the account has about 6,500, so I can do times, we'll do 12%. That basically gives us our yearly. If I get the account up to 12,000 and then do times 12% per year, now we're at 1,400. So another way you can look at this is, how much do I want to bring in per year? If I get the account up to 50 or $500,000 in the account and I have a 12% yield, now I'm at 60,000 per year, or $5,000 a month. Anyways, I think that there's going to be 2 more small payments that come in before the end of the month. So when I do the next video for starting with July, um, we'll see if those come in. I'm not totally sure. It is pretty much the end of the month, but um, I'm expecting the number in this column. This is the monthly. Put that in monthly. But a $55 month is pretty good. And that's one more thing we can do. The counts like this. Hopefully by December, this column will be up to 65, maybe 70 per month. That would be good. And then if we roll that into the next year, $70 per month times 12 months, we'll be creeping up on $1,000 a year. Are there any funds that I'm missing that you think would be good for a strategy like this? Again, I'm tending to want to be a little more concentrated. I've just got the 7 funds with the 2 high risk ones. 1, 2, 3. So it's really 5 regular funds. Are there any good funds that I'm missing? Let me know. Thanks for watching.